You need to make your money work for you. That's probably the most common financial advice you've ever heard, and it's absolutely true. As you save and invest more money, you'll find it easier to build even more wealth. Where a lot of people get lost is, what can you actually do with your money to earn more? There's more options at this point. Do you invest in assets like real estate or funding your own business or side hustle? Do you invest in stocks? What about gold and silver? Maybe crypto? Let's answer some of these questions. I'm going to go high level and break investments into three categories. Managed investments, anything you invest money in and then need to manage or work on, something like a rental property, your own side hustle, or maybe a franchise business. You could expect consistent returns, but this is going to cost you your time. Speculative investments, an investment you can buy into when you think the price will rise so you can sell it later. Think about buying individual stocks or cryptocurrency or precious metals. Now, these tend to be high risk, high reward, and investing in some of these assets, it even mirrors gambling. Now, both of these categories are actively managed, and I don't think that sounds like making my money work for me. I want to put my money away somewhere where it makes more money, and I don't even want to look at it. So we go to our third category. Passive investments are any investment that you can put money into and not think about it anymore. You can and really should automate your investing with recurring transactions from your bank. This is what we're going to discuss in today's video. Now bear with me, I'm going to break into three categories again, now based on time or when you want to withdraw these funds. We'll keep it simple: short-term, mid-term, and long-term. In general, investments you hold on to longer will be more volatile, but make you more money in the long run. Short-term investments are safer, but they're not going to have those returns that are as high as a risky investment that you'd hold on to for a while. So let's talk about these short-term investments first. Any money you'll need in the next 5 years or so. Maybe you're looking to buy a car, a house, you're preparing to start a family, any big purchase that you want cash to make a down payment on or just buy outright. First things first, don't leave your money lying in a savings or checking account. The rate of return is so bad, you're actually going to be losing money to inflation instead of making money. So let's start with the safest, most simple, and liquid place you can keep your money, where you're actually going to get something in return: a high-yield savings account. It's just a savings account that has a much higher rate of return than a traditional savings account. Now, these rates are always changing, so let's just call it 3 to 5% APY. And I'm going to be saying APY a lot. That just means annual percentage yield. So what percent of your investment you're earning back every year? If you put in $100 at 3% APY, you'll end the year with $103, assuming you put it in at the start. The reason these accounts have higher APYs for no additional risk or headache is because most are online only. Banks that operate only online are less expensive to run, so they can offer returns at a much higher rate than an in-person bank. You won't have all the amenities, but that's the price you pay. Now, I think this is a great option for your emergency fund. Personally, I keep mine in an HYSA. Next, we have CDs, or certificates of deposit. They're another solid option. Pretty much just a savings account that you can't touch for a period of time. Think that once you put, say, $1,000 in it, until that term is up, which is anywhere from several months to maybe even a couple years, you really shouldn't touch that money. You can take it out if you really need to, but you're going to get hit with fees if you do that. So really, CDs, you put your money in, you don't touch it until the term's up, then they will mature, and you'll get paid out your rate of return, usually a little bit higher than an HYSA. Now, I would suggest that whenever you're looking at CDs, compare your APY to an HYSA to see if keeping that money locked up is worth that boost in APY. And it's really just going to depend on what the rates are like right now. So sometimes CDs are a great option, other times not so much. There's also money market funds, but I'd advise against these unless you're seeing interest rates that significantly outperform CDs or HYSAs. They're just the less safe version of those that don't really have a high enough rate of return to justify it in most cases. Now, midterm investments. You don't need the money anytime soon, but you're not exactly waiting until retirement whenever you're going to need it. I'm only going to talk about index funds here. An index fund is just something you buy through a brokerage that acts like a big pot with several stocks inside of it. A popular one is Vanguard's VOO, which is just an index fund that tracks the S&P 500, which that's just the 500 highest valued companies on the US stock market. VOO and other S&P 500 index funds are great because you automatically get a ton of diversity. So you follow the stock market, but you historically beat a total market fund. And basically that's because the low performer companies at the bottom of the S&P 500, they're getting knocked out and making room for those rising stars that are coming up. And you pretty much just get to reap that additional reward of cutting out those companies that are falling. Now, if we average out the rates of return over the last 50 years, you can expect the S&P 500 to return a 10 to 12% APY, and that beats the hell out of any of those short-term funds that we talked about. So what's the catch? The market doesn't always go up. It rises and falls, and you might be left holding the bag if you really need to pull out during a downturn of the market. This is why you're going to want to transition these funds into short-term options as those big expenses start approaching. Now, of course, the previous success of the market, that 10 to 12%, that's not going to promise future returns. But historically, the market always goes up more than it goes down. So if you have faith in the US stock market, then that's where you want to put your money. You want to put it in either a total market fund or an S&P 500 or maybe something a little bit more capped like a QQQ, which is just tracking the top 100 companies. And that's going to give you a lot of exposure to tech, more so than these other ones, just because those are the highest valued companies. And there are other options for index funds. You probably want some international exposure through something like a VXUS, but the S&P 500 alone is an extremely strong option to keep your money in. There's other options for index funds, of course, but some fund that captures the market value in a second to get exposure to areas the first one doesn't have, that's pretty much all you need. Keep it simple. Now, I realize I spent way too much time to get to the long-term investments at the breadth I wanted to talk to them. So we're going to go ahead and close out this video here and look out for the next video in my personal finance series where I'm going to talk about retirement accounts. Peace.